Okay. Now, as you might expect for a merchandising company, inventories represent a substantial use of our assets, substantial use of financial resources. For that reason, we want to make sure that we have some controls in place over inventory. One of the key objectives is to safeguard the inventory, that is to protect it from theft, damage, spoilage, obsolescence, whatever the case may be. And then the other objective is to make sure that we are appropriately reporting inventory in the financial statements, okay? Remember that when we first buy inventory, it is recorded as an asset on the balance sheet. Once we sell it, it moves to an expense on the income statement. So ensuring that inventory is being appropriately reported is going to ensure that we are properly reporting revenues, expenses, income, and even our current assets appropriately for a given accounting period. Now, in your reading this week, you're going to learn about different inventory cost flow assumptions. Now, the one thing that I would really like to point out here is that we are just focusing on cost flow. Sometimes folks will get a little confused and think that cost flow has to match physical flow of inventory, okay? And it does not, okay? Cost flow is just how we assign the cost from the inventory account into the cost of goods sold account. The physical flow of inventory for just about any company is going to be FIFO. Okay, physically, our inventory is going to move in a first in, first out basis. But again, remember that cost flow does not have to match physical flow. For example, let's say that we were talking about a grocery store. You may immediately think, oh, well, they can't use, they can't use LIFO because, all the food would spoil if they used LIFO. No, they can use LIFO from a costing perspective. That just would not represent the physical flow of the goods, okay? The physical flow of the goods is going to be first in, first out. This is all about cost flow, okay? So if we use the FIFO method, that is first in, first out, we assume from a cost flow perspective that the first units that we purchased are the first units to be sold. This means that the ending inventory on the balance sheet is going to be comprised of what we've purchased most recently because that's going to be what hasn't been sold yet. All right. LIFO, or last in, first out, assumes just the opposite. It assumes that the last units purchased are the first units to be sold, meaning inventory is going to be made up of the cost of our first purchases. Okay, so inventory is going to be based on some pretty old purchasing numbers. All right. Weighted average cost is sort of a meet in the middle method. With weighted average cost, basically before each sale, we are going to add up the total cost of inventory, divide by the total units we have in inventory, get an average cost per unit, and that's what we're going to apply at the time of the sale. So let me say a few things here. First, technically, there is another cost flow assumption, and that is specific identification. However, we don't focus just a whole lot on specific identification because very few companies can use specific identification. In order to use specific identification, you're going to have products that can actually be distinguished from one another, okay? A common example might be, say, for example, a car dealership. Okay, if a car dealership is selling cars, each car is going to have a unique vehicle identification number, or VIN. Okay, so they could actually tell each car apart. But if you're Walmart and you have 300 boxes of laundry detergent sitting on a shelf, say it's one brand, 300 boxes of the same size, Tide laundry detergent sitting on the shelf, it's absolutely impossible to distinguish one from the other, and there'd really be no reason to distinguish between them, right? All right, so specific identification is really only going to be applicable for a handful of businesses, a car dealership, maybe a high-end jewelry store, an art gallery, something like that. The vast majority of companies are either going to use FIFO, LIFO, or average cost, okay? Now, the second thing that I will say is, interestingly, LIFO is not permitted under international financial reporting standards, also known as IFRS, okay? So if a company is reporting under international financial reporting standards, they are not permitted to use LIFO. However, it is permitted under US GAAP, that's US Generally Accepted Accounting Principles, okay? So that's something to keep in mind. Now, the last thing that I'll say is, a common question is, why on earth would anybody want to use LIFO? Well, one of the common reasons that we used to use is it could be tax advantageous, okay? Because most likely the goods that are purchased most recently are going to be of a higher cost than the older goods. So if we can move those higher costs to the income statement first, it's going to reduce taxable income, okay? So that could potentially be a motivation. Another motivation, if we're looking for something maybe with a little bit more of a, say, legitimate business purpose, LIFO does actually give the most accurate match of revenues against current cost. That could be especially significant if you're in a market where, the commodity prices are pretty volatile. So that's just something to think about. That may answer your question. If some of you were wondering why on earth would anybody use LIFO, that may help to explain that a little bit. All right. So when we're using different cost flow methods, it is going to affect a variety of items on the financial statements, okay? And all of these items are going to be different depending on which cost flow assumption we use. Now, of course, that is assuming that prices change. In theory, if the cost for whatever good we're purchasing, if it remained exactly the same throughout the year, then we wouldn't see any difference regardless of the method that we use. But realistically, we know that prices fluctuate pretty frequently, and it's a pretty common thing for commodity prices to change. So assuming that they are changing as they normally would, we will see differences between FIFO, LIFO, and weighted average when we compute the cost of merchandise sold, when we compute gross profit, when we, of course, compute net income, because if cost of merchandise sold and gross profit differ, it's going to affect net income. And then, of course, ending merchandise inventory on the balance sheet, and that's going to affect total current assets, which we use a lot in various liquidity measures. Again, we'll learn more about that when we learn more about financial statement analysis. But it affects total current assets, it affects total assets. So this just kind of gives you a good handle on how these different costing methods actually affect the consolidated financial statements. Now, let's look at a valuation technique referred to as the lower of cost or market, or LCM. This is a technique that we use under generally accepted accounting principles to value our inventory. And this really falls in line with the basic principle of conservatism, okay? We are going to record our inventory at cost, and we are going to carry it at cost on the balance sheet, assuming that the market value of the inventory doesn't fall below the cost. So if the market value falls below the cost, then we have to write down the inventory accordingly. Okay, that means our inventory is impaired. Basically, for some reason, we're going to have to sell this inventory to loss. We can't even get out of it what we paid for it. Okay, so maybe it, I don't know, maybe it's obsolete, maybe it went out of style, whatever the case may be. Okay, so companies reporting under US GAAP are going to have to report at lower of cost or market, so they're going to have to evaluate their inventory at the end of each accounting period to determine if any of it has fallen below market value. Now, The good news is that LCM is substantially simpler than it used to be. Believe it or not, years ago, LCM was pretty complex to apply. You had to calculate these things called the ceiling and the floor. So if any of you work in accounting or work with the accounting department, you sometimes hear people use that terminology. That was something that we used to have to do. However, they changed it a few years ago, and now when we're looking at the lower of cost or market, we focus on net realizable value, which is simply the estimated selling price less any direct cost of disposal. If there are no direct cost of disposal, then it is just simply the estimated selling price, okay? So let's look at how this might play out in an example. Okay, so in this case, we're looking at a company, and it looks like they have four products here: the Echo, the Foxtrot, the Sierra, and the Tango. All right, so we've got the quantity that they have on hand, and we've got the price per unit that they have on hand. Okay, so now we're going to look at the market value, which again, the market value is the net realizable value, and we're going to look at it on an item by item basis here. Okay, so for the Echo, we paid $10.25 for it. It's only worth $9.50. Okay, maybe nobody wants this product anymore. All right, so our total cost is $4,100. The total market value is only $3,800. We report at the lower of cost or market, which means we have to take that lower number of $3,800. That's going to be the value we report for that item. Okay, Foxtrot, we paid $22.50. It's now worth $24.10. I can tell you right now we don't have any issues. Okay, cost is $2,700. The market value is more than that, meaning we report it at cost, just like we normally would. Sierra, we paid $8. It's now worth $7.75. The value has fallen, meaning that the market value is less than cost. We have to report that item at market value. Okay. Tango, we paid $14. It's now worth $14.75. Again, if market value is more than cost, we have nothing to worry about. We just report it at cost as we normally would. So we compute cost, we compute market, and we simply choose the lower of the two. Okay, for this line, $3,800 was the lowest. This line, it was $2,700. This line, $4,650, and here, $3,920. We total that, and that is the amount that we will report on the balance sheet for inventory, $15,070.